Hi, my name is Roger Schluter. This video is actually about the personal financial statement and how the components, actually how they work for a commercial loan. Basically, I'll be explaining the different parts of the commercial or the personal financial statement and how they relate to the commercial loan. It is really a document that provides a detailed snapshot of the individual's financial situation, particularly as it relates to the involvement in a business that is seeking a commercial loan. Lenders use this information to assess the financial strength and credit worthiness of the individual, especially if they're a guarantor, co-borrower, or key stakeholder, in the business that's applying for the loan. Most of you actually will probably be sole proprietorships, but that's the same thing, and it carries even more meaning when it's a sole proprietorship because you are the business. Even though you may have an LLC and maybe they can't come after you personally, you still are the business. The typical components and explanations I'm going to talk about next in the context of a commercial loan application. Number one on every personal financial statement is the personal information. Full legal name of the individual, contact information, including address, phone number, and email, and then date of the statement. I mean, that is very important, really, because with SBA, a personal financial statement has to be within 90 days. If it is not, they will stop working on it and they'll tell you they need one that's within 90 days. Banks are the opposite. Banks don't really care. It can be a year old, sometimes 2 years old, and they don't seem to care. If you're newly working with them and you haven't been working with them for years, then they will probably want a current one. But if you've been banking there for a while and you know the people, they just take whatever you got and they give it, And so when we do SBA loans, they go ahead and they give us those, and they're like a year old, and we're like, well, we can't use this. We need it 90 days, and they're like, oh, really? So it's sometimes is a problem, just trying to get the right information. The second part would be really your business affiliation, information about the business seeking the loan, including its legal name, industry, and the individual's role in the business, whether you're an owner, a partner, a shareholder. And then also details about the individual's ownership percentage or stake in the business. The third part would really be assets. Now, assets go from the most liquid to the least liquid. So most liquid, obviously, be cash. And then the least liquid would be, things like personal assets. So anyway, liquid assets, assets that can be quickly converted to cash, basically cash on hand. Then it goes to checking and savings account balances, money market accounts, certificates of deposit, CDs, and then I'm breaking this up into different parts of the asset. So anyway, the next one would be investment assets, investments that can be readily sold for cash. Stocks and bonds, mutual funds, retirement accounts, 401k and IRA. The next part would be real estate, the value of real property owned by the individual, including primary residence and any other properties they may have. The next part is personal property, the value of personal possessions and property. These would be vehicles, jewelry, artwork, collectibles, anything that you have that's worth anything. I had a guy once that said he had an enormous amount of clothes, like, I don't know, thousands of dollars worth of clothes. We thought that was just a little weird. Anyway, the next one, then the assets are always on the left side. And then on the right side, you have liabilities, and that's what you owe. So anyway, start out for liabilities would be, at the top would be the personal debt, individuals' personal debts, such as mortgage on personal residence, auto loans, credit card balances, student loans. The next category would be business-related liabilities. And these would be like debts related to the business seeking the loan. Business loans, lines of credit, personal guarantees on business loans. And most of those people don't really have on their personal. And then the last part would be your net worth. The net worth is calculated by subtracting taking the total assets and subtracting the total liabilities. That is your net worth. And it is a very critical indicator of an individual's financial stability and ability to support the business's financial obligations. Really, when you're starting out, it isn't unusual for an individual to have a negative net worth when they're first starting out. They've got a house, it's basically all debt, and they've got other things, and they just don't have that much cash and other things to support it. So it is believable that they would. Hopefully, if you're looking for a larger loan and you want them to take you seriously, you probably need to try to get to a positive net worth. The personal financial would also, a lot of them cover income, details of the individual's sources of income, including salary, bonuses, rental income, investment income, and other sources of earnings. And then they would have, usually if they have the income stuff, they usually have the expenses too. The expenses would be, some personal financial statements forms include monthly or annual expense categories, such as living expenses, utilities, insurance premiums, and other regular financial obligations. This information does help the lender assess the individual's financial obligations and ability to meet them, because you're going to have additional, because you're going to have to meet, the additional loan that you get also. So anyway, other financial information, sometimes they have information, they will want to see tax returns. Lenders often request copies of the individual's personal tax returns. Basically, they want it to verify income and assess, kind of a financial history. Financial statements, in some cases, lenders may ask for, financial statements or additional documents related to the individual assets and liabilities. If you have a lot of stocks, they may want a listing of the stocks. But usually, most personal financials, they have the assets and liabilities on the front page, and on the back page, they have more itemized information, and one of those would be a listing of stocks. The kind of last part would be signatures and certifications. The personal financial should be signed and dated by the individual, certifying that the information provided is accurate and complete to the best of their knowledge. Some lenders may require a personal financial to be notarized for added, just to make sure that individual is who they say they are, but I've never really seen it, so it isn't used very often. It is crucial to customize the personal financial statement to meet the specific requirements of the commercial loan application, as different lenders may have varying formats or request additional information. Providing accurate and comprehensive financial information in the personal financial statement is essential for the loan application process, and it really does help the lender evaluate the individual's ability to support the business's financial obligations and repay the loan. What I am going to put on here, and you'll see it before this, I'm actually going to put an actual personal financial statement, and it's actually going to be put on here kind of over my face, not like this. I'll actually put it on there in the beginning. We'll put the first page and we'll put the second page. The one thing you got to remember about the personal financial is that you can't blatantly lie. If you do, and the business, the only way they're going to catch you is if the business goes out of business, and then that you signed a personal guarantee. So they're going to get out your personal financial statement and say, hey, what can we get here? And they're going to go through it. And since you gave them, a guarantee, they're going to go after your house. You're going to go after your checking cash accounts. You're going to have to go after anything of value that they find on here. That is usually when people get into trouble, when they say they have a bunch of stuff and then they don't really have it, or they exaggerate it to a large degree. Certain things can be kind of, I guess puffed a little bit. Things that the lender can't really check. Cash, cash that you have in checking CDs and stuff. If it, at any one time, he can't really tell how much cash you got on that day. So you can put down stuff. Just remember, if you put too much cash, then the banker's going to say, I want some of this cash in, as equity for your loan. So you'll get a lesser loan and have to put in, cash, which you may or may not have. So be careful with when you pad the cash. Let's see. Other things, you may have stocks. If you have a lot of stocks, you may, it's easy to say, well, I had this many at this time and a little less, at this time. So, and people do, they sell stocks and buy new stocks. So, that can be, I hate to say it, but it can be puffed a little bit. Some other things, real estate cannot, but you are not a broker. So when you take real estate, you can just go ahead and say, hey, it's worth this much, in my opinion. So a lot of times when the banker looks at that, he knows that you're given that value, which may be high or low, who knows, unless you get an appraisal on that property. That's the only way to accurately know. He might have a good idea just because he does other loans and reads other people's personal financials and forecloses on properties and whatever. So he may have a good idea, but even he will have to have an appraisal to actually know really what the absolute is, the value of that property. When you get into automobiles, same thing. You're not a car broker. You don't really know what they're worth. You're just going to put down a value on those. When it says cash surrender value of life insurance, a lot of people get this mixed up with the value of their life insurance. Cash surrender values, if you have a whole life policy that builds equity over time, and that cash value would be the cash value that you have in that life insurance policy. Now, if you have a term life, which is different, a term life is basically just you don't build any equity in it. You have let's say a life insurance policy of like $100,000, and that's all it's ever going to be. And then and you pay so much per month to have that $100,000 at any time in case you would die. Then they would pay off that amount. Let's see. When you get into things like vested interest in other businesses, when you get into business ventures, when you get into those are valued at whatever you think they're valued at. And I've seen people put down businesses that's, I know I've said before, I had a person came in my office and they said, yeah, I'm going to sell my business to my son. And I said, okay. And I said, well, what do you think it's worth? And he said, like $3,000. I started laughing and I was like, oh my God, how could you do that? And I'm like, I'm really sorry. I go, it just seems like a lot to me. And he said, and he goes, well, I don't, and whatever. So anyway, that was a very bad thing to do on my part. So anyway, let's see. The last thing would be, things that you have, like personal assets and personal property. A lot of those things you would actually, value, and you may value them a lot different than somebody else. Now the liabilities, you're never going to puff those up, and you really should be accurate as long as they're things that the banker can check. Property, loans you have on property, any loans you have with a bank, loans you have on automobiles, those should be given the exact amount. And things like if you owe taxes or something, you really should put it on there. I know a lot of people forget. They don't feel like those are real loans, but if you owe money to the IRS, it's a real liability. So anyway, usually the personal information is at the kind of the top of the personal financial statement, and then on the first page. And then there is the assets on the left, liabilities on the right, and then like I said before, your assets minus your liabilities equal your net worth. Then usually, if they have a part on income and expenses, personal, they'll have that on the bottom of the first page usually. And I'm actually looking at an RMA. Used to be called Robert Morris and Associates, but I think it's called, I forget exactly what they're called now. But anyway, it is RMA, and they are a financial, they do training for a lot of bankers, and so they have these personal financial statements. And this is kind of an old one. It does say Robert Morris and Associates. So anyway, that's the first page, and it usually has the bank's name on the top, and like I said, a date on it when you do a date on this, you want to make sure the date is the same date that you sign the bottom of the second page, because you don't want two dates on it, because they're going to take the earliest date. They're not going to take the latest date. So if you put a date on it like January 1 on the front, and then on the back at the where you sign it, you put it like February 15, they're going to use February 15. So anyway, you want to make sure those are the same, or at least when you sign it. Let's go through here a little bit on all the parts on the front. When you have cash, when you have loans, when you have mortgages, the back is going to have a little section on that. So they're going to section on like cash and checking accounts, non-marketable securities, marketable securities, investments in real estate would be your house and stuff. And they're going to break those out. I mean, to give you an example, on the investments in real estate, they're going to have the location of the real estate, the date of the original and the amount, the percent that was owned by you, the market value of your investment in a percentage, and then the present balance, your monthly payment, mortgage maturity date, and then your mortgage is owed to, the bank it's owed to. They're going to have those same type of groupings for life insurance, for vested interest in profit sharing and compensation, in things like IRAs and stuff. Business, usually they'll have a little part on business ventures, and then parts on loans owing to banks. And then they'll have a bunch of usually writing that says, hey, we're going to use this information to, assess your ability to get this loan. And then they're going to go ahead and you have to sign it and date it. Now, I can't tell you how many of these we look at that are not signed and not dated, or usually they'll date them and they will not sign them. They have to be signed. And with SBA, even if you're the only one doing the loan and you don't have your spouse's name on it, with the SBA, she has to sign your personal statement also. If she has any value in any of the assets, which usually she has part ownership in the house or part ownership in the checking account or something. So, but usually they're very adamant, and I know there's called a Section B rules that say that the banks are supposed to keep separate individuals if they apply for a loan individually, and that's right for banks. SBA is not, they do not have to abide by that Section B rules and regs. So anyway, they can do whatever they want, and they say that the spouse has to sign the personal financial statement. So we always say, just do it, don't worry about it, it's not worth fighting over. So anyway, that's the personal financial statement, and it is looked at very closely by banks. It is looked at very closely by SBA and by anybody really that's lending money to you. So you want to take it very seriously. So anyway, thank you very much. I really appreciate it. If you like this kind of content, I hope you subscribe, hit the bell for future notifications of videos, and please, if you liked it, please give it a thumbs up. If you liked anything in the video, my name is Roger Schlueter, and I will definitely see you in the next video. Thanks.